Okay. Hello, everyone. Okay, so statement of cash flow. We did a little bit of intro. Today, we will focus on the steps that we need to take to prepare statement of cash flow properly. And so we will go over the format first, and then we'll go over the steps. And then we will show that with a example. We'll do it together. Now, to help us to to use the time efficiently to do this example, I post a worksheet on the Brightspace. Now, if you download it, if you still have access to it, that's great. If not, you can just go along and then you can go home afterwards to fill it in. So, okay, so this is sharing. Okay, so last time we did a bit of an intro of a statement of cash flow, focusing on the different measurements, cash versus accrue. And today we will start with the just, we're going to prepare statement of cash flows. I think this is, what are the formats, right? So we'll start with the formats. We already know there are 3 sections of statement of cash flow according to different types of activities. Operating section of the statement of cash flow usually is listed first, followed by the investing, and the last one is financing. It's important that in the statement of cash flow, the inflows and outflows are listed separately. We do not net them. Okay, for instance, if during a period you refinance your debt, you issue a new loan, use the proceeds to pay off the old loan, you have to list both the inflow from the new loan and the repayment of the old loan. You don't net say, well, my debt level didn't change, but there's still cash flows. For operating sections, there are 2 different formats you can choose, the indirect format and the direct format. So the indirect format, well, actually we should say the direct format is more intuitive, right? Cash flow, inflow, outflow. So the direct format for operating activities is just that: cash received from customers for goods and services sold, and the cash paid for various expenses that incurred to earn that sales revenue, right? So that's it. So that's kind of have the advantage to be very intuitive. You know what's cash, where it came from, what it's used for. The indirect method is, for practical matters, it's 99% of the times that's the method company used, right? So it started like operating activity is already reported once. That's in the income statement. Right? Income statement mostly focus on the operating activities, and the net income is the summary of the results of the operating activities. So indirect method start with that net income that already cover the same activities, except in the income statement, you measure them differently. Okay, so you start with that net income, then you adjust for the differences between the accrue measure and the cash measure. So that's the two. Investing and the financing, you only have one format, so you don't have choice. It's only operating activity part. Okay, both IFRS and ASB encourage but do not require the use of direct method. But direct method is very rarely used. So the argument for direct method will be it's more consistent with the objective of the statement of financial statement of cash flows, provide like the inflows, outflows, you know, and especially if you want to project the future cash flow, that seems to be more relevant. Some people consider that inflows, outflows is more useful than the change in working capital account, than the adjustment. In the past, the cost, the reason most companies use indirect method, in my view, it's a practical one, because the IFRS and ASB, neither one requires a particular format. However, there is a requirement. It doesn't matter what format you use, but the company should reconcile the accrue-based operating results, which is net income, with the cash-based operating results, that's CFO, cash from operating activity. So essentially, even you're not required to use format, but doesn't matter whatever format you use, you pretty much have to give me a indirect method of operating cash flow, because you have to reconcile the difference. So why do something twice? If you do one, you can kill two birds with one stone, right? In my view, that is, it's not for like a which one is better, which one serves our purpose better, which one like just why do more work when you can do less? In the past, there is a bit of a cost is a concern, you know, but now with the computerized accounting system, you know, the extra work involved, the cost involved to prepare either format is not big a deal. Okay, so the direct method exception, I could safely say probably 99% use the indirect method. Occasionally you see company, you know, they just take pride in their like financial statements. They will give you both actually. The indirect, the focus on the difference between net income and the cash flow. And in the past is considered less costly, as I said, it's no longer a big issue. The reporting, and this is argument is actually from information quality perspective. We kind of like, we emphasize so much about why we use accrue-based accounting. Accounting is so, like you have a profession, had a lot to do with the complexity created by accrue-based measurements. If like a cash-based measurements is used, accounting is very straightforward, right? So we do emphasize that. So the idea is if you report income statement based on a cash-based, that's what the direct method is used. You make it give people the wrong impression, saying cash matters more. So that's the last argument, right? But anyways, that's the argument. So to prepare statement of cash flow, you need, first of all, you need a 2-year balance sheets. You need the income statement of the year, and you need additional information. That though just as income statement balance sheets are not enough, you need additional information. Okay, we'll see what we mean by that. So different textbook offer different steps. None of them is the right one or the standard one, whatever works for you, right? Like the gap does not say anything about what approach you use. But anyway, I kind of happen to like this 4-step, maybe not maybe just 3, but I think these steps are pretty good. So we'll stick to that. So the first step is just to determine the statement of cash flow differs from all other statements. Is before you start, you already know where you should end, because you have balance sheet, you know what the beginning cash balance is, what ending cash balance is, and what is the change, right? You just want a more informative explanation. Okay, so first just to determine the change in cash and cash equivalent. That's where you're going to end too. And the second one is to record information from income statement onto operating activity section of the worksheet. Remember, we said the income statement and operating activity section of the statement of cash flow reports same activities, only the measurement approach is different. So you copy that there. And then these categories over, you listed it here, these are actually next, you adjust for the difference. Overall, there are 3 categories of differences you need to adjust, okay? So the order here is the first one is change in working capital. For instance, in our intro example, we said the sales and the cash collected from customers differ, and the difference is reflected in change in accounts receivable, right? So by the same logic, the expenses and the cash paid for the expenses may not be the same as well, and the difference will be reflected in accounts such as wages payable, accounts payable, income tax payable, prepaid expense, right? So that's just difference between accrue and cash measure. So that's the first category. The second category is cost that incurred and paid for in a previous period. Very wordy, non-cash expense. Depreciation, okay? Depreciation, amortization, impairment loss. All these expenses does not have cash payment accompanied. So we need to adjust for that. And the last one is the amount that were reported as gains or losses on the income statement where the underlying activity is not operating. So for instance, we had like a little example at the end of the last class. That is when you have gains, was that gains? Yeah, we have gains from sale of PPE, right? That gain is included in income statement. However, this transaction is investing transaction. Any cash flow that arise from this transaction will be investing cash flow, right? So in order to report that properly, we need to remove the gain from the operating section. So that's the third category adjustment. Anyways, so that's actually the next step. So the next step is just analyze changing each statement of financial position account, identify all cash flows associated with the changes in accounts balances, and the recorded effect on the statement of cash flows. Now, in a worksheet, this category includes those changes we just mentioned for the operating activity section. But by identifying changes in financial position account, we also uncover the cash flow associated with the investing and the financing activity. So once you finish that worksheet, all the information you need to prepare statement of cash flow is right there. And for the operating activities part, both direct and the indirect method, it's right there. Okay, with that, let's look at the example. There are 2 more examples in this slide, but it's very difficult to discuss the example with on the PowerPoint because you can only have so much information on it at once, right? So I leave them there, you know, practice with it, make sure you're good with it, but I will use it separate when we work so we can lay out the worksheet properly, right? So I will stop there. So the one that I'm going to talk about is I labeled it as a complex statement of cash flow because it covers a couple of issues, little step up from the very basic ones, right? So this is the income statements. Lakers is the company's name, and these are the balance sheet, okay? And there are some additional information, but all these I also show them on the Excel worksheet. So we're going to look at it closely when we move to Excel worksheet. Okay, so the Excel worksheet, am I sharing it? Let me just make sure I share it. Share it. Okay. Oh. Okay. So that's see, I will try to get it all in one. Okay. So here I lay out that this are the financial statements we just looked at, right? And here are the additional information. Okay, so let's just look at the, these additional information first. So Laker Corporation is a publicly accountable entity and classifies interest paid as operating cash flow and dividends paid as financing cash flow. This is, we need to know for public company. Remember, for interest and dividends, both received and paid, if it's what do you call private entity that reports under ASPE, you don't have choice, right? You don't have choice. But if you follow IFRS, you have a choice. So we should know what's the choice. Obviously, you can choose yourself, but at this point, like usually that's a decision made, you know, you have a team in conjunction with the advice of the auditors, you know, you make that decision. So for us, the decision will be made for you. Okay, so that's, we know how it's done. The first additional item of additional information is during the year, Laker obtained land with a fair value of $10,000 in exchange for its common shares. Okay, so when you look at the statement of financial positions, the land should like increase, and the 10,000 increase is not paid by cash. Its purchase is in exchange for shares. So this is the additional kind of issues, right? So this transaction is actually non-cash transaction, right? Because, you know, no cash change in hand. You get the land, you issue the shares. And so we need to know that because this one will not be reported in the statement of cash flow. This is not the same as the company issued the shares for 10,000 cash and then use that 10,000 cash to purchase land. In that case, you will have financing cash inflows and the investing cash outflows. But this is not that. This is different. This is the shares are issued directly to the seller, so no cash change hand, right? So this is called a non-cash financing and investing transaction. There are also non-cash financing transaction or non-cash investing transaction. So for such transactions, for the reason probably you can guess, it's not included in statement of cash flow, but must be disclosed as a note to the statement of cash flow, okay? Because it's very similar to you issue shares, get cash and use cash to buy land, but it's not actually the same, right? So this is how it's not in a part of the statement of financial position proper, but it's disclosed as a note to it. That's first one. Equipment with an original cost of 46,000 and the carrying amount of 14,000 was sold at a loss during the year. Additional equipment was purchased for cash. So the equipment had a busy year. They have sales and they have purchase, right? So with the information for sales, we can figure out what the purchase was, right? And also they told you they sold at the loss, and that loss is in the income statement. That's why it's not repeated here. It's there, and we know what to do. This is an investing activity. So anything that's included in income statement, we're going to remove it, right? All the cash associated with the statement is going to be in investing. So that's that. A third item, all depreciation and amortization expense are included in operating expense. So it's not listed here, but it doesn't mean there's not there, right? It's not listed here doesn't mean it's not there. And we can figure it out what the depreciation expense is, because we know how the accumulated depreciation account changed, and we know in addition to depreciation expense, the sales of equipment also affect that account. So we can figure it out. Okay, so we can go with the first step if we wish. Let's just do the first step and then we'll do it. So step one, okay, so I already laid out. So this is the 4-step approach to prepare statement of cash flow. Okay, so the first step, we start with the cash balance at the end of the year, December 31st, 2020. Okay, so from the balance sheet, the end of the year, we have 92,000. Okay. Oh, I'm going to put it in the wrong column. And the cash balance at the beginning of the year, that is 18,000. So increase in cash during the year is 74,000. So that's the first step. We know that's where we should end. It's a little bit small, isn't it? Yeah, okay. I can make it a little bit bigger, but yeah. Oh, see, that's the thing. Yeah, that's okay. I think slightly bigger, but not, doesn't lose anything. And then I will put the step 2. I will use the same space for this because you know, otherwise we'll be repeating. So let's say step 2 for now. Step 2, we're just going to copy everything here to here, right? So we have for operating activity, we copy all the items in the income statement here. I had a couple of extra lines, just you don't really need it, but just for me to show you the details later on. The first would be the sales or sales. So the wording is a little bit funny. So I would like just to describe the event in this column, because later on you show how it's measured in accrue, how it's measured in with the cash, right? So I think it is proper to label this item in terms of what happened. But textbook use, I think that I accrue, like I just say revenue. I would rather say sales, sales and activity. So I'll say sales. So on the income statement, this sales is 645,000. Okay, and then the next one on the, it's all on the income statement, is cost of goods sold, And on the income statement, at 314,000 negative, okay, because this is the expense and associated with cash outflows. There, where sales is a revenue and the cash counterpart is cash inflow. So I will do the, and I will leave an extra row here just because 2 working capital accounts reflect the difference between cost of goods sold and cash. And a third one is operating expenses. So operating expense there, it's a negative 274. Now I leave 2 extra items because there are 3 accounts for the difference between accrued measure of operating expense to cash measure. Okay, so and then interest. Okay, interest. And interest, I was put it in here. Interest is 5,000 negative. And the next one is loss on sale of equipment. I know we need to remove it now, but it's in the income statement. So I need to list it here and then later on to adjust it. And the last one is income tax. Income tax, which is 13,000. Okay, so just to verify, and I will add it up, and I should have my net income here, right? So the net income matches that. So this is accrued part. And then what I'm going to do is I'm going to use this column to make an adjustment. And I have an extra column here to kind of explain. And eventually I want to compute the cash measure. So I'll show this part as these are a kind of the accrued measure here. So I will blue, and the cash measure here, I will make it a different color, like a green, something like that. So that's what I'm going to start with there. I'm going to adjust all the difference. And in the end, yeah, I want to have that cash, right? So that's second step. Now, I have operating activity here, but I also have other, I will add on. And now I want to figure out the adjustment. And remember that the various manipulation we did with the balance sheet, like so changing cash equals change in the rest of the accounts. Remember that? Yeah, that's good to go to visit a bit. So that will show you what I mean, where which one is gonna. So it's in this slide, that's I add this one previous class, which you will not find it in the textbook, but it's going to be very handy today. So where is it? This is the one, remember? So changing cash is really some of the change in the rest of the balance sheet account. And after we carefully desegregate and rearrange it, we concluded that change in working capital account here and the net income that's operating, change in non-cash, non-current assets is investing, and change in non-current liability and shareholders equity and dividends, that's financing, right? So we're going to look at the balance sheet and to identify that. So now let's go back to this. So this is what I'm going to do here. I have the space here for purpose. So I'm going to analyze each one of them. So first one, change accounts receivable increase. First of it's operating or investing or financing. This is operating, right? This is operating because it's the difference of sales and cash collected. Okay, so I would say this is operating, it's the difference between sales revenue, actually between revenue and cash collected. Okay, further, because this is an increase, how are we going to adjust it here? It's an increase. Remember that one I just showed you, the change in cash is a negative change in assets plus change in liability, right? So if it's assets increase, we subtract. If assets decrease, we add. So here we are going to subtract that difference of 12,000. Okay, so that's the if you want I have this one for explanation, but since I just carried over there, I'm not going to repeat it now. The next one is inventory. Is it operating? Yeah, it's operating, right? And that's it's actually the difference between cost of goods sold and inventory purchased, right? Yeah, it's the difference between cost of goods sold and purchase, inventory purchase, right? And again, here we just remember that if increase in assets requires cash, so we subtract it. Increase in liability give you cash, so we add, right? So this is change is negative, so we're going to add here. I won't show the plus sign, but the adjustment is actually add, right? And the next one is land. Land increased by 10,000. The first item, additional information, give us an explanation, right? So this one is a non-cash financing investing transaction. So in the note, report in the note, not going to be anywhere in the financial statements. Okay. Next one, building and equipment. There's a decrease of 20,000. Now I have two lines here because there are two things happen. So also I create a room for both. One is the second additional items. I'll show you here. Here, equipment with the original cost of 46,000 with a carrying amount of 14,000 was sold at a loss. Additional equipment was purchased. Okay, so for this account, we know there should be a this. First of all, this is investing. Oh, okay. So maybe I should not use that that part as a green. That will be confusing. I will do it blue. Oh, blue. Okay, so investing is my green. Investing, and there are two parts in it. First of all, there is a sales of equipment, but the sales of equipment, we are going to remove 46,000. Was that 46,000? Because the cost of the equipment sold is 46,000. However, this account only reduced by 20,000. And we are also told the new equipment was purchased for cash. So that means sales of equipment and investing, there is a purchase of equipment. Is that a purchase of additional of equipment? So the sales of equipment is 46,000, right? So that's given. Guess what's the amount of equipment purchased? What is that? So that's the change is a decrease of 20,000. And we know there's a sales, there's a purchase. The sales, the cost of the equipment sold is 46,000. So that implies the cost of equipment purchased is 26. So this 26 is going to be cash outflow, right? It will be cash outflow. The sales 46, that's not cash inflow because that's the cost of the equipment sold. The cash received from that is we have to calculate because all we know is what book value is and we know there's a loss, right? But anyways, we'll come to that. So accumulated depreciation, the account, this is a negative 1,600, but because it's a contra account. So the negative is actually this account increased by 6,000, right? Right, increased by 6,000. Now, there are also two things happened, resulted in this change of 6,000. First of all, when the old equipment is sold, the accumulated depreciation should be removed, right? So we were told that the equipment sold has a cost of 46,000 and the carrying amount of 14,000. So what's the accumulated depreciation? 32,000. So this would be also investing. That's the 32,000 of accumulated depreciation of equipment sold. Okay. And so that's related to that, the sales of equipment, that's investing. Okay, so if we remove that, this accounts for the decrease by 32,000, but it turns out it increased by 6,000. So what does it tell us? What would increase accumulated depreciation? The depreciation. There is depreciation expense. We were told it's included in operating expense. We were told, but the amount we were not told. But we could have figured it out here. Hold on a sec. I think there's a question. Oh, okay. Well, I didn't hear it. So, okay. Thanks for taking care of that. So, what's the depreciation? $38,000. Good mental math. Yes. And this will be operating, right? Because we know the depreciation expense is included in net income. So operating, that's 38,000 of depreciation expense. Okay. If you have trouble to see that, I will show it here. I will show it down here, right? I will show it down here, the difference. They'll say accumulated depreciation account. Okay, so this is accumulated depreciation account. So what we know is this account has a beginning balance of 54,000, right? And we know it has an ending balance of from the balance sheet 60,000. Okay, so when the equipment was sold, the depreciation, the cumulative depreciation should be removed. Remember, we debited cash, we credited equipment, we debited cumulative depreciation, and we plug in the gain and losses. And so since the cost of the equipment sold is 46,000 and the carrying amount, which is same as book value, is 14. So we know that cumulative depreciation, this is the accumulated depreciation of the equipment sold. Okay, so with that, we should have a balance of 22, but that's not what we have because we already know the ending balance is, let me just put these, make it look more like a T account. But that's not what happened. We know the ending balance 60. So here we have to plug in a number. That's our depreciation expense. That's a number that's not given, but we know for certain that number has to be $38,000. This will be plug in depreciation expense. Okay, so that's how we figure this all out. Okay, so that's continue. Goodwill, so this is impairment, right? So this is operating, right? Because it's included, so it's operating. This is the non-cash expense / impairment. Okay, so accounts payable increased by 15,000, so that is operating. Okay, so we already have this between cost of goods sold and the cash paid to purchase inventory. There are two possible differences. So because the cost, the goods sold and the amount of goods purchased may not be the same, and the amount of purchase and the cash paid for purchase may not be the same. So the cost of goods sold and the cost of goods purchased, the difference between the two will be the change in inventory, and the cost of goods purchased and cash paid for the goods purchased. If there are any differences, the difference will be the change in accounts payable. So this is the second piece of that. I need to put it here, right? So that's operating. That's the difference between goods inventory purchased and cash paid. Okay, and furthermore, this is a liability and it's increased, so the adjustment should be, do we add that difference or do we subtract? When you purchase on credit, and so the accounts payable goes up, does that mean that the your cost of goods sold is more than cash paid? Cash paid is less because the accounts payable goes up, right? Cash paid. Now, so however, so it will reserve cash, right? But we have a negative number here, so we'll add 15,000 here. We'll add 15,000 here. Let me see. Yes. So we'll add here. We'll come back to that. Let's finish this one. This one, accrued liability. So this is related to what they have. Everything down here, tax payable, interest payable, maybe wages payable, insurance, whatever, right? So all related to that. So that's generally the difference between operating difference. It's a difference between operating expenses and the cash paid for those expenses. So that's that. And since it's a decrease, you know, we need to subtract. Long-term notes payable. This will be the issue of notes. Should it be operating, financing, investing? Financing. So financing, this is issuance of notes payable. And common shares changed from 7. So this is the change. I didn't even mention this is the change, right? It was like it just computed. Excel will spit these things out like automatically. So these are the changes. So we're talking about the changes. Common shares increased by 10,000. Is this financing? Because the shareholders' equity, right? But remember, we talked about, we know why these shares were issued, to purchase this land. So it's a non-cash financing, investing activities. So the other part of that. Retained earnings increased by 3,000. There are two things happen here, we know, because net income is 28,000. So if no dividends were paid, then that means retained earnings should increase by 28, but it's only 30, so only 3, so there must be dividends, right? So two things. One is operating part is net income of 28,000 and financing part, which is dividends, that we have to assume it's cash dividends. Because if it's stock dividends, then there's a non-cash financing transaction, right? But without those information, if they say it's stock dividends, then we will have to, there will be increase in shares, right? So this has to be cash dividend of 25,000. Okay, that 25,000 is plug-in now. So now we have all these done, and we can finish this worksheet step number 2 and number 3. Two steps on this, right? So I change that to step 2 and number 3. Okay, so this part, after I adjust for the sales, adjust for change in, this is change in accounts receivable. See, I see at the time I said, oh, I don't need to do that because I already just did that. But see, after a little while, you forget. Now, so I repeat that. So now what we get here is 63300. This is the cash received from customer for goods sold, right? And this items, cost of goods sold, after adjust change in inventory and the change in accounts payable, what I get here would it be, I'll put it here, 298,000 This is cash paid to the suppliers for the inventory purchase. So how you see, we changed from the accrued numbers to cash numbers, okay? So operating expense, there are several changes in here because the depreciation and the impairment is included in here as well. So I left the three columns here. One is the 38,000, that's a depreciation expense. It's non-cash expense, but is included in operating expense, so that it's subtracted from net income. But it didn't, there's no cash payment goes with it, okay? So we added it back. And there is a impairment, 5,000. That's a goodwill impairment, right? So that's also non-cash expense. So we included in here because both of those included in operating expense. And there's one more that is the accrued liability. That's decrease. That's decrease, and decrease in liability. That's this amount, right? That will be put it here. So that is a change in accrued liability. I don't have a change in accrued liability. So with all that adjusted, I will have 235,000 cash paid for all operating expenses. Okay, 235. Interest, there's no interest payable, and so there's no change in interest payable. There's no, right? So therefore, there's no adjustment. So interest paid is 5,000, the amount incurred. Loss on the equipment sold, we need to remove that. So the adjustment is to add, because there's no cash to be reported associated with that transaction in the operating activity section. Okay, so that's, so what should I say? I will say this is investing activity. Okay, so that's investing activity. So I'll put it here. Income tax, there's no deferred tax, there's no tax payable, there's no tax assets. So we have to conclude that is the cash, all the tax is paid, so that cash paid is that. Okay, so let's just make sure everything here is included. So so this net income is reflected in all these numbers, right? Because these adjustment is made to these numbers, and these numbers add together is your net income. So if you want to prepare a statement of cash flow using the indirect method, what you need would be this number plus all these numbers. If you use the direct method, these numbers. They're the same thing, just different details. So, right? Because these adds these give you these. And so these are real cash flow showing the direct method. These is summed up in this one number. So the indirect method would be this amount plus all this. All we need to do is to organize these properly, so the statement of cash flow will be formatted properly. But anyway, at this point, we'll leave it here. Let's move on to the next section, investing part. Okay, so investing activities. Yes, our green part, the green part we already highlighted here, right? So that's a cash paid to purchase. That's not a cash, but we have a purchase when sales of equipment. We need to count both. So the purchase of equipment is the easiest one. So I'll go that first. Purchase of equipment requires a cash outflow of 26,000. Well, no, sorry. The purchase of is it 26? Yes, 26,000, right? So it's 26,000 here, cash flow. And the sales of equipment. Sales of equipment, well, we don't know, but we can figure it out. The carrying amount is 14,000. There's a 11,000 loss. How much did we get? 3,000, only 3,000, right? Okay, so if you have trouble to see that amount, I will show it here. Like we'll do the journal entry. So sale of equipment, the journal entry will be involved in the debit cash, debit accumulated depreciation. Okay, so we know, and then debit loss, since we already know there's a loss, and the credit the equipment. So let's put the number we know in. The equipment sold, we are told, has a $46,000, right? So that's in, and we know the carrying amount is 14, so that implies accumulated depreciation is 32. And we know the loss is in the income statement, so the loss would be a debit of 11. And so that's only 43 on the debit. There's a 46 on the credit. So that means this must be 3,000. So this is a plug in or plug. We call it a plug, right? As a plug, right? So that's one. Okay, so nothing else because there's only two purchase and sales of the equipment, right? So now let's move to the financing. Financing, we have two purposes. One is issuance of the note, of notes payable. And now we have already figured out the issuance of notes payable. It's 40,000. Yes, that's a 40,000. And the second one is the dividends, cash dividends. Cash dividends is 25,000. Okay, so that's our second and third step. So this provide us with, let's put it in the same color. So this will be the green and this part is purple. I do all these, so it will be everything ties up so you can make reference easily, right? So, okay, so now the rest is just to organize this information into statement of cash flow, right? So I have already prepared it, so maybe I will just oh, so this is what I will do. I already prepared it. Should we want to, there's just a lot of typing. I don't want to do it here. And I have like less than 10 minutes. So I already prepared it. So I will download it. I will show you. So we'll just walk it through. Before we look at that, let's say that for the direct method, okay, it's everything you need is in this column. Everything here is the direct method, right? So because on operating, the financing and investing, that's just one way to do it. But for operating, that's cash inflow, cash outflow. Okay, a little bit difficult to see, but if you see it, it makes so much sense. Is the indirect method. The indirect method is this part. Okay, let me just show it. this part equals to this part. Oh. Agree? Right? So this part is equal to this part. And in this, the accrue and adjustment, all the accrue number adds up to this, all the accrue number adds up to this one. So I could say, instead of including these ones, I will replace that with just one number. That's just this number. Right? Because all these numbers add up to this one number. So the indirect method start with the net income. It's here. Adjust for all the differences between accrue measures and the cash measures. I should give you the same cash flow. Right? I should give you the same cash flow. So with that, let me find the one that I already did. So that would be good because it will be just the time for today. Hope I got the right one. Yes, I have that. Okay, so now let me share it. Stop that one. Oh, shoot, which one is the one? I think this is the one. Okay, so yes, this is the one. So I have everything here, but I also have the financial statement, the step 4. Step 4, I have the financial statement in both formats. Let me just shrink a little so it'll fit in one. Okay. Okay. So for the, sorry about this is small, so I will do the little bit bigger for the direct method. This is the direct method. Okay. And just enough. This is the direct method. This part I want you to see. Oh, sorry, this date is different. Okay, so it should be 2020. And this should be 2020. And this should be 2020. Okay, so that's just mine. So here we have for operating section, we have all the cash inflows, outflows from this column, give us a operating cash from 82,000. And for investing, we have from this, the section of the investing activity here, right? We have that. And for financing, we have from the last part, it's here. So we have 3 cash flows added up to a net increase in cash of 74,000, which explain the change from 18 to 92. Tied it up, all done. Don't forget this. Note, $10,000 of common shares were issued in exchange for land during the year. That's required, okay? So that's the direct method. After all the work is done in this worksheet, once that's done, the rest is straightforward. The indirect method, I need to shrink it a little to show that, is here, okay? Indirect method is here, this part. I just reorganize it so it will be presented in a way that's more organized and better to read. So remember 3 category adjustment, I separated them from net income. First, I adjust for non-cash expenses, right? In here we have depreciation and impairment. And then the second one is the items included in the income statement, but the underlying transaction is not operating. That's the sale of PPE. So we have sales of equipment result of loss included in this 28,000. I need to add it back. And the third part is change in working capital account. So there's change in accounts receivable, account inventory, accounts payable, accrued liability. And actually all these change end up to 0 because they canceled out, right? They canceled out. So still give us a cash from operating activity, 82,000. And the rest are the same. Don't forget the note. Don't forget the note. You still have to have the note. In addition, this we're going to talk a little bit more. When we have a direct method, we have cash paid for various items here. But when you have indirect method, you do not have cash paid for everything. In addition to non-cash transactions, everybody is required an effort to, doesn't matter what method you use, to show the interest paid and tax paid. The total interest paid and tax paid. That's a disclosure requirement. So if you use the direct method, you don't need to disclose it because it's already in here. There is income tax paid, there is interest paid. But if you use the indirect method, those payments are not in the statement of cash flows. So therefore, in addition to the non-cash investing financing transaction, we also need to disclose interest paid and tax paid. Okay, so that's all for today. There is a quiz. I make it not available yet just because I want to see how much we covered today. We did finish the whole thing, so you should be able to do the quiz, which is for Friday. And that's the last quiz, and then we will have the last assignment after the this chapter. We're getting close to the end. Okay. Have a good weekend. See you next week.